Welcome to your Deep Dive. We cut through the noise, bring you the critical insights from the latest earnings calls. Today, we're unpacking the Q2 2025 results for Highwoods Properties, ticker HIW. They're a big player in the office REIT space, especially focused down in the Sunbelt. We'll get into their financial performance, their strategy, and why management sounds pretty optimistic, even though, the market had a bit of a different take on call day. Kind of interesting.
Indeed. Yeah, we're going to look past just the headlines here. Try to understand the underlying drivers, really get to the why behind the numbers, because Highwoods is navigating a, let's say, dynamic landscape.
For sure. Okay, let's kick off with a quick look at those Q2 numbers. Highwoods reported funds from operations, FFO, of $0.89 per share.
Right. And that actually beat analyst estimates by, about 4.7%.
Yeah, a solid beat. Revenue, though, came in a little under expectations, $200.6 million.
Which was a slight dip year over year, about 2.0%.
Okay, but here's the kicker, right? The market reaction.
Exactly. Fascinating stuff. Despite that FFO beat, management sounding positive, the stock dropped over 4% on the day. And the trading volume was unusually high.
So it suggests investors were maybe weighing broader office worries more than the company's actual results?
That seems to be the read, yeah. Weighing those macro concerns pretty heavily, at least initially.
But operationally, looking inside the company, things looked pretty strong. Leasing momentum was good. 923,000 square feet signed up.
And a good chunk of that, 371,000 square feet, was new leases, not just renewals.
Their leased rate, that went up 80 basis points from Q1, now at 88.9%.
Well, occupancy, the actual bodies and seats, held steady at 85.6%.
And the balance sheet looks solid, too. Over $700 million in available liquidity.
Plus no major debt coming due until, Q2 2026? Gives them breathing room.
Okay, good snapshot. Let's unpack this a bit more. Dig into the financials and operations. FFO first. They raised their full year 2025 guidance.
Right. This is the second time this year they've bumped it up.
Yeah, now expecting between $3.37 and $3.45 per share, midpoint $3.41.
That's up 2 cents from their April guidance, 6 cents from their first outlook back in February.
So positive trend there.
And, management kind of flagged that the underlying picture is even a bit stronger than that suggests, because that FFO increase came even with some headwinds, like higher G&A costs, some interest income getting pushed out.
So they overcame those.
Yeah, offset by higher expected net operating income, NOI. Shows pretty good operational control.
Speaking of NOI, what's the guidance there?
For same property cash NOI, they're guiding for the full year between -4% and -2%, with average occupancy expected somewhere between, say, 85.0% and 86.5%.
Got it. Now that leasing momentum, 923,000 square feet signed, included pretty strong rent growth too, right? JAP rent growth was up 17.6%.
Right, that's the longer-term view smoothing out concessions. And cash rent growth, the immediate bump, was 3.6%.
So interesting, expansions from current tenants beat contractions by almost 3 to 1.
And nearly 20% of the new leases were to companies totally new to their markets. Suggests some in-migration pull.
Okay, this raises a key point about future occupancy. You mentioned the leased rate is 88.9%, but occupancy is 85.6%.
Exactly. That's a 330 basis point spread, which is, it's double their historical average spread.
So what does that spread really mean for, someone listening?
It means there's a pipeline of future income already locked in. Leases signed, tenants just haven't moved in or started paying yet. It's like embedded NOI growth that's contractually obligated. It points to future occupancy gains.
Okay, that makes sense. But their projection for year-end 2025 occupancy is actually towards the lower end of their outlook, around 86, 87%. Why is that?
That seems counterintuitive, Rice, but it's a strategic choice. They're sometimes proactively taking space back early from a tenant.
Okay. Why do that if it lowers occupancy temporarily?
To get ahead of future vacancy, maybe reposition the space and lock in a better long-term tenant. It manages rollover risk. So yeah, a short-term dip on paper for a potentially much better long-term outcome, a calculated move.
Right, playing the long game. And the balance sheet, debt to adjusted EBITDA.
Stood at 6.3 times. Still a bit elevated maybe compared to some peers, but they're managing it.
And crucially, after the quarter ended, they extended a $200 million term loan.
Yeah, push that maturity out to January 2029. That really helps solidify their debt ladder and gives them flexibility.
Good context. Were there any unusual items in Q2 we should flag?
Yeah, a couple things. They got a $3 million payment from Florida's DOT for some roadway improvements, kind of a one-off boost.
Okay.
And about $1 million in termination fees, mostly from taking that space back proactively like we just talked about.
And on the other side?
They wrote off nearly $1 million in pre-development costs. Basically decided some sites weren't the best use for office anymore. Shows they're refining their strategy.
Okay, that's a perfect pivot then. Let's talk strategy. Because this is where it gets, I think, really interesting. And management's framing this as a shift, right? From defense to offense.
Exactly. And it's not just talk. You see it in their actions. They're actively recycling capital, selling off assets that are maybe slower growing or need more capital.
And buying properties that fit their profile better. Higher growth, more capital efficient.
Precisely. They're projecting about $145 million in sales and $138 million in acquisitions for 2025. It signals a clear shift. Less focus purely on the balance sheet, more on driving NOI growth through leasing and asset quality.
And they're very focused on unlocking what they call embedded NOI growth in specific assets. They highlighted these core 4 properties, Alliance Center in Atlanta.
And then 3 in Nashville, Symphony Place, Westwood South, and Park West.
And the potential upside there is huge, right? Like $25 million in annual NOI potential across just those 4.
Yeah, it's significant. And they said they've already secured, or scotched, as they put it, about half of that upside with signed leases.
Plus another 20% is in sort of strong prospect stage. So real progress there.
And then there's the development pipeline. That's another big growth engine.
$474 million total and already 64% pre-leased. That's a good sign.
Yeah, includes projects delivered last year like Glen Lake III in Raleigh, Granite Park 6 in Dallas.
And upcoming ones for 2025, like 23 Springs in Dallas and Midtown East down in Tampa.
You add it all up, those core 4 plus the key developments, it's over $55 million in potential annual NOI growth above the 25 outlook.
Wow. And over $33 million of that is already locked in, with signed leases expected to start paying by late 2026.
That's a very visible growth trajectory they're laying out.
And underpinning all this is their belief in the Sunbelt. Their best business districts, or BBDs.
Yeah, they keep emphasizing the strength there. Charlotte, Dallas, Nashville singled out as top performers 1A, 1B, 1C. Tampa's strong too.
And the macro context supports it, right? The Southeast driving so much of the U.S. job growth since early 2020.
Over 2/3 of it, according to their numbers. That's a massive tailwind for office demand in those regions.
So this ties into that idea you mentioned earlier, the slow squeeze play.
Exactly. It's about supply dynamics. Across the U.S., office demolitions and conversions are way up, expected to hit over 23 million square feet in 2025. But new deliveries, only around 13 million square feet.
So net reduction in supply.
Effectively, yes. Especially when you add in the construction pipeline being at a multi-decade low. This creates a favorable setup for owners of the best buildings in the best locations, like Highwoods aims to be.
Because it costs so much more to build new now.
Right. Management pointed out replacement rents for new builds are often 20% to 40% higher than current market rents in their BBDs. It makes existing high-quality space more valuable. Fewer chairs available in the musical chairs game, like we said.
So they expect concessions have probably peaked, market rents starting to rise.
That's the expectation, which should help net effective rents over time.
Although they did caution that tenant improvement dollars, TIs, and leasing commissions might stay elevated for a bit.
Yeah, through 2025, maybe 2026. Just because the sheer volume of new leasing they're doing takes capital to get deals done.
What about retaining current tenants?
They're projecting a 45-50% retention rate over the next 18 months. That's actually higher than their historical average.
Suggests existing tenants are generally happy to stay.
Seems so. And demand is coming from various sectors: professional services, law, accounting, banks, healthcare. Plus, those companies moving into their markets.
Did they mention AI at all? Or artificial intelligence impacting office needs?
They touched on it, acknowledged its early days, obviously, but they drew parallels to past disruptions, like office densification trends a few years ago. Basically suggesting the office sector adapts and the core need for a collaboration space remains.
Okay, so let's pull this together. What's the bottom line for someone tracking Highwoods? Operationally, strong quarter, beat FFO, raised guidance, lots of leasing, embedded growth potential, optimistic outlook from management.
That initial negative market reaction hangs there. It seems investors on day one focus more on the year-over-year revenue dip, maybe the 6.3x leverage figure.
Even though they're actively managing that leverage down.
Right. Just broader worries about the office cycle in general. Maybe not fully buying into the Sunbelt differentiation yet, or the embedded growth story.
So the narrative from management is clear. Pivot complete, now it's about offense. leasing-led growth.
Exactly. And the proof points, the catalyst to watch, will be hitting those leasing targets on the big developments like 23 Springs and Midtown East, filling up more of that core 4 space. And maybe some smart capital recycling, selling non-core assets.
They're framing 2025 and 2026 as this bridge. Right. A bridge to higher occupancy, steadier cash flow, and ultimately NAV growth.
That's the plan they laid out.
All right. We've dissected the results, the strategy. Now for the part where we put on our hypothetical investment committee hats. This is explicitly not financial advice, just some creative, maybe outrageous but plausible thinking sparked by the call.
Purely a thought experiment. Let's call it the not financial advice segment.
Okay, trade idea number 1, the lease-to-own discount arbitrage. Premise, that 330 basis point spread we talked about, leased rate at 88.9%, occupied at 85.6%, double the historical average.
Representing, as we said, future NOI that's already contractually locked in, baked in cash flow.
The play. The market seems fixated on current occupancy, maybe missing this visible future growth. So a contrarian longer-term view might involve going long HIW, maybe using long-dated call options, say 12, 18 months out, slightly out of the money.
The thesis being, as those signed leases actually commence rent payments, occupancy climbs, FFO grows, the stock potentially re-rates higher. Closing that gap, that discount between the lease potential and the currently realized occupancy, fits management's steady cadence of occupancy build.
Okay, plausible, if contrarian. Idea number 2, the Sunbelt squeeze play. Premise. Highwoods is concentrated in these Sunbelt BBDs where office supply is getting tight, demolitions outpace deliveries, construction is low.
And replacement rents are significantly higher, remember, 20–40% higher in many of their markets. A clear supply-demand advantage.
The play here could be something like a pair trade. Go long HIW.
And simultaneously short, a diversified office REIT ETF that holds assets in, say, non-Sunbelt or more challenged market.
Right. Trying to isolate Highwoods' specific Sunbelt advantage. Betting on the performance gap widening between their kind of markets and, well, struggling legacy markets elsewhere.
Hedging out some of the broad negative sentiment towards office while capturing the specific upside potential in Highwoods' chosen locations.
Interesting ideas. Again, just thought experiments. So, wrapping up our deep dive on Highwoods Properties. Strong operational quarter, beat FFO, raised guidance, demonstrated solid leasing momentum, all driven by that Sunbelt strategy and the embedded NOI growth potential.
Yeah, but tempered by that initial negative market reaction. Likely, as we discussed, driven by broader macro factors and maybe overlooking some of the company's specific positives and future trajectory.
So as you reflect on this, maybe consider the real meaning of that 330 basis point spread between leased and occupied. And think about how that slow squeeze in Sunbelt office supply could genuinely change the game for strategically positioned companies like Highwoods.
Does it present an opportunity for investors who can look past the immediate headlines and focus on where the fundamentals seem to be heading?
Something to think about. This has been your deep dive. Hope you're leaving with a clearer picture.
And just a final reminder, everything discussed today is for informational purposes only. It is absolutely not financial advice. Always do your own research, your own due diligence, and consult with a qualified financial advisor before making any investment decisions.